Well, thanks again, Michael, and thanks everybody in Flya out there who's both investors, current investors, and those of you doing discovery and diligence on the offering. We appreciate that. We appreciate everybody behind the scenes at Flya as well for making this happen. This is great. So Rob Jaffick is one of the founders and basically managers of the Boomerang Finance Fund, and we've been operating for 5 years. We'll talk a little bit more about that towards the end. Really, what we want to do today is sort of educate you on what's going on in the market. We like to always tell ourselves and tell everybody we talk to that we're pretty boring in what we do, and you'll find that if you talk to us about what we do in our strategy. But the headlines certainly aren't boring. They're quite exciting lately in terms of housing and rates and all of that. We've talked a lot about that this morning. That's the whole point of this. So we're still pretty boring, however, right? When you get right down to the fundamentals of what we do, we're actually very boring. So I'll be back and forth throughout the call and this presentation talking about answering some of the questions, but I wanted Rob to jump in and kind of walk through some of the headlines and sort of parse through the numbers, get some of the mythology ripped out of that. So Rob, I'm going to turn it over to you.
Yeah, so thanks for that, Chris. We are boring in that we are non-correlated and non-volatile, but there's a lot of exciting stuff going on. So I'm just going to take control of the. So Chris and I. So look, what are we talking about? I think the prior two presenters talked a little bit more about their fund, which is great. Very interesting stuff. The pictures from Italy and the plan over there is certainly impressive, and I do feel a little underdressed relative to Brian and definitely the presenters from Perugia. So, but look, so let's get into it. Let's look at some of the headlines and some of the things that you've seen. This deck is available if you want to see, when I pulled these things, but. U.S. housing market is in a free fall as builder confidence suffers disastrous drop from an economist. Mortgage demand falls to the lowest level in 22 years amid rising rates and slowing home sales. And the existing home sales dropped for the 7th straight month in August. So these are some of the recent ones. And so certainly the conclusion could be here that real estate is crashing. But it's really so let's look at these. Let's look at these individual claims. Let's look at what they're looking at. Let's get back to let's get to the source data and see what it is that they're looking at that's causing them such concern. So this first one that they're looking at, the housing market in free fall, is builder confidence suffers disastrous drop. What they're looking at is the NAHB Wells Fargo Housing Market Index. And really anything below 50 is bad. So you can see two things when you look at this chart. First off, it has fallen off of a cliff. We can use a little bit of the hyperbole that we've borrowed from some of the commentators, and it certainly does look bad. That is a significant fall. I don't think it probably bounces back like it did in the pandemic. So, and it's clearly below 50. So these people are very concerned about that market. But let's see exactly what that market is. So I'm going to read this to you. I know that's not the greatest PowerPoint presentation stuff, but let's read it so that we are looking at source data. The NAHB Wells Fargo Housing Market Index, the HMI, is based on a monthly survey of NAHB members designed to take the pulse of single-family housing market. Good so far. The survey asks respondents to rate market conditions for the sale of new homes at the present time in the next 6 months, as well as the traffic of prospective buyers of new homes. So we're looking here at new homes. We're not looking necessarily at all homes. We are calling up the builders of these new homes and we're saying how you doing, how you feeling, what's it looking like. But it's new homes which are different. So if we're going to look at new homes and they're going to be a little different than existing home sales, let's look at that. So I just picked Phoenix. We sit in Phoenix, so it's a little easier for me to drive around and see what it looks like and that sort of thing. So this is from Realtor.com, I think, highly credible source. And they're looking at the median listing home price versus the median home sold price, which is really important because this is another of the headlines. I skipped it, but asking prices are dropping. Okay, great. Let's look at that. So we've got listing home price versus median sold price. The listing home price here, the average listing price in Arizona and that's the red line, the top line, is 470,000. The actual traded price is 430. So you've got about a 10% bid offer spread. That is historically high. You can see back in 2000, in 2020 or so, the spread got high, but 10% is a high spread. It's not normal. So when we think about, hey, asking prices are dropping, well, of course they are. They're 10% too high. You have a 10% bid offer. And what's happening, like Chris talked about a little bit earlier, is sellers are still wishing it was spring when 100 people came and viewed, and you could wipe all the contingencies and you had to do cash settled. So it's 10%. It's too high. I got off on a little tangent there, but so the traded price is around $430,000. So what's going on with new build? Why is it, how can it be any different? So this is kind of fun. We take the top home builders in Phoenix. This is according to New Home Source, which seems to be pretty credible. And you have an average price of $640,000 in new builds. Now, you don't have to be much of a rocket scientist to figure out if prices are getting less affordable and people are getting priced out of the market, that you are more likely to be purchasing a house priced at $430,000 than you are to be purchasing a price at $640,000. Why does Lennar feel so bad? Why can Lennar blame it on all sorts of things other than the decisions that they've made, right? It's supply chain problems. It's the interest rate. It's anything but the fact that our price is $500,000, it's almost $100,000 premium to what's available out in an existing home. So if you're a new home, and certainly there's some problems here. Brian touched on them just a little bit with why are we building luxury homes, those sorts of things, right? Local governments are non-supportive, neighborhoods are non-supportive, the land and the commuting problem is a problem. So yeah, you're building them further and further out. You tend to be building a luxury product that tends to be able to be better to do. You've got a lot of builders switching into multifamily and building in density and those sorts of things. But look, at the end of the day, you've built a product that's a premium product, and prices have gone up. You've moved away from the market. So if you want to say real estate is crashing, and you want to be specific that new build real estate is crashing, I'd have to, looking at the data, I'd say, yeah, I can see that. So let's move on and look at mortgage demand falling to the lowest level in 22 years. Look, nobody's using a mortgage anymore. Oh, that must be really problematic. Y'all know this one, right? So I just picked this one out of, it's not all mortgages, right? So this one splits it into 3 different pieces. That's why the yellow line, rather than the bar chart, is interest rates. Interest rates go up. You shouldn't be looking at the dark blue line. That's new purchases. You can see the new purchases are, kind of fairly solid. They don't do that much. The yellow line is refinances. Okay, so refinances are also going to go down, but it's the light blue bars. That's what's crashing. It's refis. You don't have to be a rocket scientist on this one to figure out either. If you've got a mortgage at 3%, 4%, and you have the ability to refinance it at 7%, you're probably not going to do that. So, or you're not going to do that. So refis for real estate certainly are crashing, but the fact that mortgages, the new purchases is pretty solid. It's always pretty solid, by the way, like that. There's mobility. It's not 100%. We'll look at that in a minute. But refis for real estate certainly are crashing. So if you're asking anybody involved in the mortgage industry, how's it going? They're not going to be happy either. So let's look at this one. Existing home sales dropped for the 7th straight month in August. So home sales, right? Home sales are dropping. That must mean that the real estate, has gone moribund. And indeed, if you look at this one, this is pretty eye-popping. Volumes are down 20% year over year. So if you're going to ask a realtor, total existing home sales are down quite a bit. And if you look at it on a longer term basis, right, we were trending around there. That's this pandemic, the post-pandemic, right? Pandemic, right at the beginning of the pandemic, we dropped to 4 million, but then we were getting up towards 6.5 or so. We've now dropped to 4.8. That's what a 20% decline looks like. So that one is relatively significant when you're looking at volumes. So the volumes of real estate are crashing, and so you may not want to talk to a realtor when you try and figure out what's going on with prices. So the tenet of this one, the premise of this one, and certainly we've looked at three things now, maybe four, seems to indicate the price. Look, everything in real estate is bad, right? Hang on a minute. Let's go look at the prices of real estate and let's ask if, is that really true? So, and really the first thing anybody's going to look at is Case-Shiller, right? And it is up on a stick there, right? You look up on the right-hand side and you go, wow, it's all going to mean regress. So all I've done is I've taken this data series and put in the trend line since the data series started in 1987. That is too simplistic, right? You can't just do that. Well, yes, economic models are basically built on mean regression. We've talked a little bit about mean regression today. We'll talk, maybe use it some more, but that's too simplistic, right? We're not taking account of the changes in inflation. We're not taking account of the changes in demographics. We're not taking account of the changes in demand based on the pandemic or based on people working at home. That Brian Bailey with that multi-generational 4x up since 1971. So maybe people don't want to be, that was eye-popping to me. So maybe people don't want to, and then maybe people don't want to be doing that. And then the supply differences, right? We have not been building enough houses, not the right type of houses either. So the new build guys need to be building first move-in homes, and that's problematic and that's tough. So there's been a lot of changes here, and really so let's get back into price, right? So one of the guys that's quoted the most as far as prices goes is this guy over at Moody's, Zandy. Good economist. Disagree with him on a couple things, right? But mostly how he sees the rehabs. But let's start with him. And one of the things that I really like about him, again, super respected, but also he's going to come out with, it's not just prices are going lower. We don't disagree with that at all. But it's also, you want to look at magnitude and timing, right? If prices are going lower, if I say, if you buy an asset today and it's going down for sure, okay, well, by how much? So we want to get the direction. We also want to get the magnitude, how much, and for how long. So right, so direction, magnitude, and timing. So he goes into all of this. So he says, if you look from left to right, in 2022, the house prices are increasing at 15%. He thinks that they are going down, that house prices will actually depreciate. And look, it's like 7% in 2023. So let's look at exactly what he said, because the headlines tend to use him a lot. This is lifted right out of his, including the bold. Many of these highly overvalued markets may now be primed for price depreciation. This depreciation will likely not, however, be a crash like the one we saw during the Great Depression. We're expecting house prices to retreat between 5 and 10% in the most overvalued markets. So 5 and 10% in the most overvalued. If there is a recession, drops will be higher between 10 and 20% in the most overvalued. What's the base case? Nationally, moderate depreciation in house prices is coming. Prices will continue to rise through the end of 2022, but at a much slower rate than in 2021. There will be a modest price declines in 2023, and then prices will mostly flatten. If there is a recession, prices will drop further. So again, this is what he ends up looking like. And this is why it feels so bad, right? There was a big spike up in price appreciation, and the first derivative here is massively negative, right? So it was going up, and we thought, we said, it's going up at 16%, but that's not going to persist. This is Fannie Mae's expectation, and you can see their expectation is it never drops below zero in this time frame. One of the things I like to do when looking at markets is use markets to look at markets. So we are going to look at the CME trades futures on the Case-Shiller index. So we're gonna go look at that. And all I've done here is I've taken the Case-Shiller index, I put it into a graph so I can make some changes. And then what I've done is I've taken the futures here and figured out the futures, used the futures to project into the futures. Whatever the futures are looking for in the futures, that's what I'm looking at. Sorry, this is the Case-Shiller. I should have stuck a label on this one. The other thing I want to do here before we get too deep into it is a decline of 50 on a base of 200, which is kind of where we were back in 2004 and that sort of thing. Looks different than a decline now of 50 because we've elevated, right? Everybody knows that. So what I'm going to do is I'm going to log this whole thing, right? So we're looking at log base so that we can compare percentages to percentages. And we're going to take this comparison and we're going to compare it last time and we're going to compare it to now. So last time what we had, the peak was in July of 2006 at 184. The trough was in February of 2012. That's a 27% decline over 67 months. So then let's just take that little box and put it this time and see what it looks like this time. Using the futures are expecting a low. The high now is maybe 308 in June. The futures are saying it's going to be 313 in November. When I pulled them, they don't move around that much. And I will caution you on using these futures. They're not the most liquid things in the world. So we're trying to look at a bunch of different things to make sure that they all fit. Be careful with the futures as well. But so then what we're doing here, what we end up with, so the high is 308 in June, or maybe it's 313 in November. The low is 273 in February of 2024. That gives us an 11% decline in 20 months. And this big flat, the same thing that the Moody's guy was saying. That's what the futures are expecting. That's what it seems like most of the economists are looking for. So here's what the experts are saying. Moody's, modest price declines in 2023. You don't like Moody's, you want to use one of their competitors. Let's look at Fitch. Natural home prices were overvalued 11%. It never mean regresses to theirs, but that's what they're saying. Fitch will even say that. Fannie Mae, decline of 1.5% expected for 2023. Freddie Mac, their competitor, they're still looking for an increase. Goldman Sachs, you want to use the street instead. Home prices will decline by around 5 to 10% in the U.S. from a peak in the U.S. They're not so optimistic on the rest of the world. They're a little more bearish there. And Morgan Stanley says home price growth will turn negative in the first half of the next year before finishing 2023 at down 3%. Those certainly aren't scary. So real estate is crashing. That's the premise. But if we look around a little bit, Michael, my thing didn't work so great, but you get the idea. New build real estate is crashing. Refis for real estate, you could say, is crashing. Volumes of real estate are crashing. But if we're looking if the prices of real estate are crashing, they certainly don't look like they're crashing. They look like they're moderating. So with that, I think we'll turn it over to questions. I talked kind of fast, and that's kind of good. But so any questions? If not, I've got a couple coming in. I got a couple coming in direct to me, which is kind of fun. Not what I expected. So Chris, I don't know here we go. Many family offices and individuals actually make loans themselves, similar to what you are doing. Why would they want to do it via a fund rather than on their own? Okay, so the advantages of a fund really are threefold. Family offices and individuals do these on their own, and then they get the full benefit, right? We charge a little bit. We guide to 10 to 12%. We've been hitting 10 to 12% for a long time, right? That's us relative to the S&P. The orange line is us. It looks like we're trending higher, but we're not really. It's just because the S&P is struggling a little bit. So why would they do it via us? A couple different reasons. Number one, we're always deployed. So a family office and an individual, you're going to go out and do a loan. It's going to work out great for you for 6 or 9 months or whatever. And that's great. But at the end of 6 to 9 months, your money is going to lay fallow until you can get another one. It's very hard to line those up end to end. We line it up end to end. We're in a fund. Number two, if anything goes wrong, and we have about a 1% foreclosure rate. Industry average is around 3%. Part of the reason we do that is get that is because we service our own loans. We have awesome people that service our loans that are employees of ours, and so we get much more direct feedback much quicker. So, but when that 1%,
Michael, do you have any questions coming in on your side?
So I'm getting a couple, and you can cut me off whenever you want, Michael. So what do we think of Miami? Okay, so this is a great question. It may not seem like such a great question because we do Arizona, Colorado, Texas, Utah. We do Western states. Um, we don't do Miami. I don't really know, right? And leave that to professionals over there. But the other piece of that question is, yeah, there are different markets doing different things, and the Case-Shiller index, all of the stuff that we just looked at, that's a national level. There is huge variance in real estate, right? Real estate, there's three things that matter: location, location, and location. So if you're seeing significant variance in your, oh, I drove down the street and I saw X or Y or Z, yeah, and that's kind of why you wanted another plug for the fund, right? Is that variance, that significant variance as far as prices, as far as experience, or those sorts of things. That's going to work its way out because of the portfolio effect. But yeah, you're going to see a lot of variance when you're talking about real estate specifically. You're going to see a lot of more dispersion relative to experience. So yeah, take all of the national stuff with a grain of salt. That's kind of the macro. Um, so, all right. A question: what are historical defaults and how are they running now? Okay, that's actually a really interesting question. So our historical defaults are around 1%. As Chris just mentioned before, we're pretty boring. Our defaults, they're 6-month loans. So our defaults currently running our loans that we're seeing now are the loans that we made back in the peak times. So our default rate is now running at right around 1%. It's actually running a little bit less than that, but not statistically meaningful. So what does that mean for us? What do we read into that? First off, they're 6-month loans. We've been doing this since 2009, 2006, somewhere in there, depending on how you count whether we had out. The turnover was so high, they were having to wait for cabinets. They were having problems with cabinets. Now, because people are looking at people want a lower priced product. They're not waiting for specific cabinets or anything like that. They're doing off the shelves and those sorts of things. So the turnover, our turnover is actually higher, and you're just not getting our borrowers. They've got about 20 or maybe 30% skin in the game. So a price depreciation over a 6-month period of 3%, or they're not even going to notice it, and there's other ways around it. So we are not seeing a significant pickup in default rates at all. Our guys are adjusting, and it just kind of isn't. We're not the place to look for defaults. Sorry about that. So, other questions coming in?
So, Rob, is there any
Yeah.
way that we can talk a little bit about the fund?
Yeah, we can. Yeah. What would you like to talk about? You want me to introduce the fund, or what do you want to do?
Yeah. Please introduce the fund, and if you don't mind, I'm going to pull it up on the
Oh yeah, the
marketplace so that
marketplace.
people know where to find it.
So
And
the fund, we've been talking about house prices. We actually are lender to this. So we lend into this, the REIT. We are structured as a REIT. We are a mortgage REIT. We lend into this business. Obviously, we're interested in the end. The average loan is a 6-month loan, and so we've got a lot of turnover. In this fund, in the first quarter, we will be just over $1 billion originated. So there's quite a bit of turnover. There's around $150 million worth of equity in the fund. the states that we're concentrated in, Arizona, Colorado, Texas, Utah, that we already talked about, mostly Arizona and Texas, we are very transparent with our exposures. So if you're thinking about this type of fund, this type of investment, if you're a family office and you're doing this anyway, you have to make 4 decisions, right? You have to source the deal, you have to underwrite the deal, you have to worry about portfolio construction, and then you have to service the deal somehow, right? So sourcing the deal, everybody, some of that will come and find it yourselves. You're going to be, people will take your money all day long. We have to be very careful with that. We are a relationship lender, so we actually go out and meet our borrowers. People who have struggled in our industry right now are people who are transactional. We're relationships, so we're going to go out and work our relationships and find. Generally, we're not lending to the guys who haven't done this before. Average guy is going to have do 5+ a year. So we're going to source. We're going to underwrite. We say no to about 7 out of 8 proposals to us. And we can cherry pick even better now, which is nice because of some of the struggles around. So we can cherry pick. Underwriting, we're trying to. The magic isn't trying to figure out the after rehab value. It's not the current value. We can kind of figure that out pretty well. Just look at trades. It's the after rehab value. They're going to put money. They're going to take this asset and they're going to turn it into a better asset. What's it worth in the future? And then we got to figure out the future. So underwriting is important. Then it's a portfolio. You cannot stop at just underwriting. Oh, a good loan. I'll just take a bunch of good loans and that'll be my portfolio. We're going to worry about we're going to worry about state concentration. We're going to worry about stage concentration, right? What stage are they in? Because these are going to go down in value before they go up. They're going to go through the J curve, normal value add preposition there. So we're going to worry about what size they are. We're going to worry about how many we've got in construction loans. We don't like construction loans very much, but we'll do a little bit of them. So 75% of our portfolio is going to be in very light rehab, no permits, those sorts of things. So that's the third thing you're going to worry about. And then servicing. It's kind of a pain to do some of the servicing. But we do it ourselves because we want to do it. If you are just assuming, out of the goodness of your heart that people are going to send in their money to you on time, I think you're pretty mistaken, and I think you're going to have troubles in this environment. Our people have to chase up. Hey, we normally have, probably 5 to maybe 10% of our people that have problems with making their payments on time. Generally, they respond relatively quick. But you got to keep up on insurance. You've got to keep up on, all of the taxes. You got to make sure that, the seconds and those sorts of things are filed properly behind you. So those are some of the things that we do as a fund. Those are the 4 things you're going to have to worry about. We do those all different than most of our competitors, especially the servicing. Servicing and relationship lending is kind of our secret sauce.
What's the duration of a typical loan?
6 months. It's a 6-month loan. We originate generally at 12 plus 1. So we are a little bit of a premium to some of the others. You see some of the other guys saying, oh, we lend out at 8% or whatever. Yeah, but then they load you up with junk fees and they do Dutch interest or some of the other things that we think are not so cool. But it's 6-month loans. And people can extend. We do extensions. But we're written at a 6-month loan. Right now, we have about 12% of ours that have gone over that 6%. That 6-month loan.
And Michael, it's also really quick. It's important to note too. You take a look at, we've got 721 loans in the portfolio right now, approximately. Generally, we're running 2 to 3, maybe 4 months on average historically in maturity. They pay off pretty quick. So the velocity's there, which is really nice because we get to redeploy it, make investors whole if they want to get out at the end of their cycle, or redeploy the capital, what have you. So we like to keep that money moving.
Have you guys noticed any change in demand for for these types of loans as rates have gone up?
So I'll say 2 things. First off, not really, right? So this is guys are doing. You got to remember the people that we're lending to, they do it as a business. This is just a business that they do all day long. So normally about 5% of the transactions in the U.S. and that is super stable, right? 5% of the homes in the U.S. need to be value added. 5% of the homes are getting that value add. It's pretty stable. On the other, so the rise in interest rate, and we're at the lower end of the market, right? Our average loan is $373,000. So we're not doing those multi-million-dollar homes. We're not doing those sorts of things. The turnover, there's a lot of demand still for first-time buyers, and we're doing a lot of that. So the second piece of the puzzle is you got to think about it. It's kind of the size of the pie, and maybe the size of the pie is changing a little bit, right? Some of the volumes are falling off, and some of those things are compressing the pie overall. But our slice of the pie is actually expanding. Why is ours expanding? Because some of our competitors are having, some of our competitors really were brokers at the end of the day, and brokers are having problems. The CLO market, they were selling into the CLO market. And the CLO market is closed. I think Brian touched on that a little bit as well. So that's been a problem. Some of our guys that are transactional, right? They are struggling, right? You want a borrower has an issue, or a borrower has a question, or a borrower, and you call up one of those lenders and you go, oh, hey, I have a question on my loan. Oh, I don't know. I don't service your loan. I don't know what's going on. We sold your loan. Don't talk to me. So we're getting a lot of the relationship lending is coming back to definitely help us in this environment. So our slice of the pie is getting a little bigger as well, and the industry overall is fine. The average home in the U.S. is 40 years old. The average home in the U.S. Needs to have its roof redone. It's not just about aesthetics. It's the plumbing. It's the HVAC. It's all of those other sorts of things. And they're just not building a lot of these new homes anymore. They're of first-time buyer homes, or kind of average homes. What they're building is luxury homes. That means that the market of current inventory needs to be refreshed, aesthetics and performance.
Why do you guys stay out of certain markets like Florida?
Why do you pick Florida out of all the markets we could? So Florida. So this is our backyard, right? We know what's going on. I want to have Porter go drive, a bunch of our properties. We can go do it. We being a relationship lender, every once in a while he'll take donuts and coffee to the guys. So it's in our backyard. Miami also, we need to be very careful with judicial versus non-judicial foreclosure states. The foreclosure process in Florida means that when one of these goes wrong, and great, it's only going to be 1% or whatever the number is going to be, but when one goes wrong, I can't get a hold of that property in Florida for around 200 days, and God forbid that one of our borrowers moved into that thing, and I've got to evict a current holder. That's going to be very problematic in Florida. So we're not disposed to do Florida. Will we look at it from time to time? Yes. Is it a core market for us right now? No. And we'll look at the same thing. It's not just Florida, right? We don't like California. The bite size is too big. We don't. The bite size is too big. The rates are too low, and it takes too long to get a hold of it. The judicial foreclosure states like New Jersey and New York and those sorts of things, they are very difficult to begin with. And the pandemic has not been kind to their ability to service clients like us.
So that brings up my next little question. Are you an attorney?
Am I an attorney?
Yeah.
No, but I am a adjunct professor at UC Berkeley in the law school. We get around a little bit. Yeah. So, no, we just spend a lot of time on this. So, and these do go. You got to look at your contracts going in. People do say our contracts are a little bit larger, right, than most. I don't know what our current stack is, but it's over 80 pages for a borrower. So we try to, contemplate the things that are going to go on. We need to, build in there a little bit of the nuance as far as different states and those sorts of things. So we try to think about it in advance. The other thing is for good or for evil, right? We've got some scars. We've definitely seen some things. I think that if you're doing one or two off a year, like you're a family office and you're doing these, and you go, great, we've got a dozen of these. We've originated 4,000 or 5,000 of these things. So we've seen the anomalies, and then you incorporate it into your deck, into your legal deck, your stack.
Have you guys had to look at more deals to keep the pipeline, the underlying pipeline full and the funding full?
Well, so yes and no. So our historical is one out of, we say yes to 1 out of 8. I would say, yeah, now we're saying yes to 1 out of 9 or 1 out of 10, because some of those borrowers that are, I talked about our slice of the pie, and that slice of the pie, our slice is expanding a little bit. We are seeing more junk, right? My old lender, he's not around anymore. Boomerang wasn't our first pick, for whatever reason, but I'm going to come over to Boomerang. Well, maybe there's a reason that your lender said no. So we're having to work. Our guys, I think that if I had a loan officer on, or I thought about putting David on today, I think they're just as busy as they've ever been. But I do think I actually perversely think we're saying no more. But being in the batter's box, we're getting more pitches thrown at us. So we're keeping it out.
So, Rob, how do you see the Boomerang's fund performing in a rising interest rate environment?
I think Chris said it before. I think we're about as boring as ever. We guide to 10 to 12%. The rising interest rate, there's two pieces of that that's going to hurt, right? One is less buyers, less people can buy homes. We already talked a lot about that people are still interested in buying homes. We're kind of in the right part of the market, if you will. There's a lot of still demand. There's constrained supply. So that piece is kind of good. We do use a bit of leverage. We're lightly levered. We're about 30% leverage. So yeah, when our cost of leverage goes up, it's not so great. Why do we continue to use leverage? It smooths out, right? Why can our returns be so stable? You have to balance supply, sources and uses, right? Sources of funds is debt and equity. And then the uses, we've got borrowers, right? So maybe the borrowers want to borrow a little more. Great, we'll just take it out of the leverage. Oh, maybe they've increased. We'll just pay down the leverage. So we want to. It's really a bad thing when borrowers come to us and say, "Hey, we'd like to borrow money," and we go, "Oh, sorry, we're out," right? Which might happen to a family office. Oh, we already lent out our money. But to us, we've already got somebody else, an unlevered fund. So that's what that light little bit of leverage does for us. And yes, when the rates go up, it does hurt us. We are back to roughly the same level as when we started the fund. Our leverage comes to us at just over 7%. So we're lightly levered. You can figure out the spread, right? 7%, you're lending out at 12, plus points is going to be 14. So, your pickup that used to be 700 or 800 basis points now has been compressed to 500. That compression is within the guidance of 10 to 12%. That's 10 to 12% net, plus a little pickup in the tax benefit.
So here's something, I know you come from a macro background.
Yeah.
So you heard Brian's presentation earlier today.
Yeah.
It sounds like the Federal Reserve's going to be a little bit more aggressive going forward with their accommodative policies for money. Do you believe that they're going to be able to accomplish this, or what? How do you see things? How do you see things unfolding? With rates and inflation and.
Yeah, I think Brian is looking at the same thing, and his office is looking at the same thing. Pull up a yield curve, right? And the yield curve gets pretty steep, but then it rolls back over. right? The Atlanta Fed, we love the Atlanta Fed. The Atlanta Fed does GDP now. The Atlanta Fed does wage tracker. The Atlanta Fed is really proactively trying to educate, inform, and put their forecasts out there, whereas some of the other Feds don't. But let's compare the Atlanta Fed relative to New York Fed or the Cleveland Fed. And one of the cool things that the New York Fed does is they put out an inflation forecast. They think inflation goes up for a while and then it moderates. Cleveland Fed would say the same thing. If I'm looking at markets, I like to look at markets. So we can look at the 5-year forward for inflation. We can look at the 5-year tips. We can look at the 10-year tips. All of those tend to suggest that inflation is coming down towards the 3 or 4% level. So we've got a short-term problem. Absolutely, we have a short-term problem, and inflation is going to continue to be a problem. Probably, in the 7, 8s, that sort of thing. Could we get a spike above 10, 11, depending on what you're looking at? Whether you're looking at core, non-core, that sort of thing. So we could definitely have a problem in the short term, but you're not going to try and do that. You're not going to try to adjust in the short term. Remember, the Fed, it affects short-term rates. Fed does not. Well, you can say that they affect it somehow with the some of their sales and those sorts of things, but most often they do the Fed rate, which is the short-term rate. So that's what they're going to have to do with. And if you're doing with that, I think you're going to have a problem. I would look back at the 70s too, where inflation, they fought it for a while, they got it under control. They fought it for a while, they got it under control. They fought it for a while, they got it under control. Inflation is a difficult thing to deal with. So when the Fed says, "Hey, we're going to be this is." Maybe, and you heard Brian say, hey, maybe we're going to be a little bit tighter, or his boss prefers to be a little bit tighter for a little bit longer. I think that makes sense. I mean, that's, it's a question of a little, right? So yeah, fight this bear, fight it a little harder, kill it a little more dead than maybe otherwise you thought about. But this is not, there's a lot of moderating things that'll offset this. And I think, core inflation is going to drop down to the 5s. Depending on what, again, how long you're talking about. But the next 3 or 4 years, I have no reason to disagree with the 5-year tips that we're going to be sub 5.
So you tried to ask him a question about politics.
Yeah, that was me. Yes.
He wouldn't bite on it.
He would not bite.
He wouldn't bite on it. Where were you trying to go with that question?
I don't have a dog in that hunt, but I just wanted to see, the claim is that certain parts have been much more accommodative as far as giving out money. That's inflative, but awesome. How do you stop that process? And in the are we going to swing? The political question is are we going to swing from one extreme back to the other? How do they even think about that? Are they looking at short term? Are they looking at long term? I would say that he tends to suggest we don't look at it at all. That's not right. You're swimming in a pool. The politics affects your pool. You can't say I'm just gonna those guys in the other end of I'm not gonna pay attention to them. So he's got to pay attention to them. I just wanted to see how they think about those sorts of things. I think that he tried to dodge it because he thought it was a political. I like red or I like blue or whatever, and I totally respect him for that. I was not trying to throw him under the bus for that one. But how do they think about that? And how do they take it into account? Because they have to take it into account. And if you're going to ask me which way, if I'm going to bet red or I'm going to bet blue, I don't know. I don't know. I don't know.
I mean, it would seem coming into an election, the aggressive nature of their rate increases hasn't been the most popular thing, but
probably depends on who you're asking, right? Some people, if you're the gal that's getting $20,000 of your debt forgiven, your student debt forgiven, you're probably pretty happy about that.
And have you seen recently people talking about weaponizing the Fed? This came up
Not.
in the last week.
I haven't
So
really.
not only
Yeah,
they're being accused not only of politicizing, but also weaponizing against Russia.
I don't know. There's always extremes going to say, this or that or the other. I haven't. I haven't really seen that. You reading Breitbart or you reading Mother Earth News? Which end are you looking at?
I don't know where I think I caught it on Apple mainstream news.
There you go. Yeah, no. People are always looking. People are always going to try and figure that out, and I think we've got to be relatively careful. I do think the Fed does a very, very good job. I think they have a crazy difficult job, right?
Yeah.
And they've got two mandates, right? Full employment is one of their mandates, and fighting inflation. How do you fight inflation? You take a hit on unemployment. How do you fight employment? You get loose on inflation. They've got a very difficult job. I think Brian did a very good job today of saying, yeah, we're going to have to give a little bit on employment. Somebody asked a question, are you going to throw housing prices under the bus? And are you going to sacrifice housing prices? And I think that is a good question. Sacrifices do have to be made. And I think they're going to get a little bit more, less accommodative towards employment as you'd have to do, right?
Well, guys, I appreciate you coming on again, and welcome you back anytime.
Great.
It's always great to have you as part of the community. Thank you.
Thanks, Michael.
I'll be following up
Appreciate
with a presentation, a copy of today's presentation, a recording of today's presentation. So, as well as a link to your marketplace. And Jeremy and I are up next. We are going to use your marketplace listing to show people.
Awesome.
So,
thank you.
All right, guys.
Great.
Thank you.
Thank you, guys.
Have a great day.